Time flies when you're having fun. And there is no bigger proof of that than the fact that the first wave of millennials are turning 40 this year. Basically, millennials are starting to get old. As you age, there are positives and negatives, as I'm sure you know. Your physical prowess starts to diminish. You can't run as fast or jump as high. Trust me, I know. But your finances should improve. Trust me, I know. Where should you be in your financial life once you have hit, or in my case, are approaching the big 40? Well, like many things, it depends. Let's dive in after introductions, of course. I'm Derek West, and I host this awesome channel, Finance Squared, the channel on YouTube where you get real talk about your finances and how to improve them. And not just the hype and fancy cars and Lambos, etc. that you get everywhere else. Well, the question is, who are you? Where are you in your financial life? Are you closer to 40 than 20? Hint, if you're older than 30, that should give you a clue. How do your finances look? Feel free to answer any of those questions in the comments down below and introduce yourself to the Finance Squared community. We love having you here. Also, subscribe, like, and share this video with your fellow finance enthusiasts because they will get good value out of this channel. The central question of this video is, where should you be in your financial life when you're roughly 40 years old? How do you know if you're measuring up, falling behind, or getting ahead of your finances at this time in your life? Well, you can tell where you're supposed to be by looking at 3 different aspects of your financial life: your debt, your net worth, your income. These are the 3 legs of a healthy financial stool that will secure your future and current prosperity. So with debt, where should you be in your journey when you're starting to hit your 40s? A lot of people on finance-centric channels will tell you that you should have 0 debt when you're in your 40s. Your student loans should be paid off, you should have no credit card debt, and you should already have paid off your mortgage. And you know what? They're right, partially. We really need to separate our debts into 2 very different types of debt: consumer debt versus investment debt. Now, consumer debt is the debt that hamstrings millions of people across the country and across the globe that is usually fueled by credit cards and automobile loans and, yes, mortgages. None of those things are bad in and of themselves. And if you use consumer debt wisely, it can fuel your financial well-being by enabling you to get debt for other purposes, namely investment debt, by powering your credit score. If you can get close to achieving a perfect credit score, let's say 780 or above, and you have a proven track record of paying your debts back on time, and also wisely utilizing the available credit that you have by having a high credit line, but utilizing less than 20% of it at any one time, then you can eventually turn that around into purchasing assets that rise in value over time. And that takes us to investment debt. There's probably a better term for that, but I really don't know of one. But what I mean by investment debt is owning pieces of an asset that pay you back eventually. The most common type of investment debt is in real estate. That is, taking out a mortgage to own a home that you then either fix and flip or turn into an apartment rental, which you then utilize to pay down the mortgage so that you own an asset that you pay minimal for, increasing your overall net worth. So now that you're approaching your 40s, where should your debts be? Well, your consumer debt should be minimal. In reality, your consumer debt should be 0. By now, you need to realize that most consumer debt is generally a bad idea. The reason for this is most consumer items generally depreciate in value. There are some exceptions, but that's the rule. And if you're purchasing those things with debt, you're basically going into the hole twice. And what do I mean by that? When you purchase consumer goods with a loan of some kind, or more commonly with credit that you let turn into a multi-month balance, not only did you pay for something that will rapidly depreciate in value, but now you're paying interest for it on top of that. And paying interest on consumer items is one of the ways that you stay poor. If you're still in debt by the time you're closing in on your 40s, there's no need to worry either. There are a couple of different ways to get out of debt. 2 of the more popular ways are the Avalanche method of debt relief and the Snowball debt relief method. Both of those are great ways to get out of debt. I personally prefer a combination of those 2 methods. Now, that's a topic I could talk about for a long time. I'm not going to go over that in this video for the sake of your time. But just know that you don't necessarily have to pick one or the other. There is the possibility of combining the 2 in ways that fit your personality and goals the best. But if paying interest on purchases is how you stay poor over time, earning interest on assets you purchase is how you become rich over time. I'm going to be getting specific about that coming up a little later in the video, so stay tuned. But if you're investing in something that requires you to take out a loan, for example, in a home that you are going to rent out, learning the difference between the interest you're paying and the possible return you could get can help you determine if that investment is worth it or not, or if now is the right time to sell it. Truth be told, that is one of many metrics, and a more detailed discussion on that is really a topic for a completely separate video, so make sure you're already subscribed. But by the time you're in your 40s and you're looking at your financial life, you need to know and be taking advantage of the differences between paying interest and earning interest, and that will set you up financially for the next 40 years. You see, getting your debt under control will allow you to expand your net worth at a much more rapid pace than simply using savings alone. What do I mean by that? Well, let's take a look. Debt can influence your net worth in negative ways. Obviously, if you're $100,000 in debt and you have no assets, you're in a major hole. A hole that you can easily climb out of if you have a strategy and discipline, but a hole nonetheless. However, debt can influence your net worth in a positive way as well. What am I talking about? Well, I'm talking about using debt to purchase assets that appreciate. Not all debt is used to buy jewelry and cars. And actually, depending on the jewelry and cars, those can actually appreciate in value as well. But most other consumer debts actually just burn a hole in your pocket, avoid into the negative zone that take energy and effort and concentration to overcome. But investment debt works in the opposite way. Since the item that you're purchasing actually appreciates in value, you taking out that loan, well, it becomes a lever to increase your own wealth. An honest to goodness mechanism of lifting yourself up by your own bootstraps. An example of this that we talked about a little bit earlier is using a mortgage to purchase a home that you either rent out or flip for profit. But that's not the only way. You could use debt to purchase a franchise or a business. It works in similar ways. Most franchises are relatively expensive upfront, so people oftentimes take out business loans to get their own franchise, or they take out business loans to start their own businesses. Now, businesses are perceived to be typically a bit more risky than real estate ventures. Whether or not that is true is probably a discussion for another video, but if that business venture works out, either you're able to grow your franchise in your area or you're able to sell it, chances are you'll be getting more money back than what you saved up to make the down payment, positively moving your net worth in the right direction. But your net worth doesn't have to be all about debt either. If you continue to buy assets with cash, you can increase your net worth without going into debt. A common way to do that, and the way that I increase my net worth the most, is via purchasing investments. Now, there are many different types of investments, and they're a favorite topic of this channel. But a couple of the key points is that typically investing, well, it has a much lower barrier of entry, especially nowadays. There was a time when if you wanted to get into a serious investment, you would have needed tens of thousands of dollars to buy into a mutual fund or something like that. Nowadays, all you need is a phone, one of the thousands of investing apps out there, and a working index finger and thumb. And boom, you have all you need to increase your net worth step by step. And there are so many asset classes out there that are worth your time. I'm talking about index funds, ETFs, cryptocurrencies, NFTs, commodities, other asset classes, all at your fingertips at a click of a button. The thing that turns investing in assets of any kind is consistency, and investing consistently over a long period of time. Growing your net worth this way is oftentimes seen as gambling to a large extent. But if you're watching the right channels, then you know that investing is as easy as 1, 2, 3. And you don't need to get into crazy exotic investing instruments. You don't need to get into leverage investing of any kind. You do not need to get into algorithmic trading of any sort. All those things are awesome, and they do work for some people, but they're also extremely risky, which is why they can be extremely rewarding. And if you need a safe investing alternative, then sticking with an index fund that is more or less pegged to a consistently growing economy is really all you need. Think of the S&P 500 or the Russell 2000. Depending on when you're watching this, they're both probably down pretty significantly, but after a period of time, they have both proven to be consistently profitable in the long term. And someone in their 40s should base the foundations of their investments on those sorts of asset classes. Another great thing about investing in index funds and ETFs is that there are so many of them out there that you can pick and choose the ones that make sense for you. If, for example, you need to support your lavish lifestyle, you can invest in income-generating assets like dividend-yielding stocks. These are the stocks of companies that are so big and so profitable but they're not really growing at monster rates like, let's say, smaller companies such as tech companies. Those companies tend to issue dividends to their shareholders, depending on their health and profitability, of course. Now, all this takes us into the discussion of income. What should your income situation be once you're in your 40s? I don't think there is any time in your life when income is not a subject of discussion. As human beings, we need income for our entire lives. When we're first born until the time we die, we all need to be able to get the resources we need to live our lives. As we approach our 40s, though, your income should start to approach a different level. What do I mean when I say that? When you're a child or you're in your early teens, most people have almost no method to generate their own income. Any income they have will come from their parents. The most enterprising of us will form paper routes or shoveling snow, mowing lawns, and things like that to get a little bit of income to pay for the things that we want. But not all of us. And once we get into our teenage years, we probably only have basic skills like reading and arithmetic. At that point, you can only really use those to get a part-time job at your local mall. Moving on into our late teens and early 20s, at this point, we're starting to get our advanced educations. We should be approaching a place where we can start to make real money by providing a real service to others. And depending on how long it takes you to do that, you could be anywhere from 25 to 26 when you start to make legitimate money. If you keep doing that, by the time you're approaching your 40s, you should have the experience and the know-how to really be able to provide value to others, whether as an employee or as a business owner or even as an independent contractor of some kind. All that is well and good, but when you're approaching your 40s, you should have at least 2 streams of income. One from your main place of employment and another significant stream from somewhere else. It doesn't have to be as big as the one from your main employer, but it should exist to help you to save up and invest just that little bit extra each month to increase your net worth overall. And here's the main point of this video. A good rule of thumb to shoot for is to have enough monthly income where you're able to comfortably invest $5,000 every month, no matter what. Why do I say 5,000 and not 2,000 or 8,000 or some other number like that? Well, 5,000 is a number that if you invest consistently every month, you can expect to have a $1 million net worth after approximately 10 years at an 8% return on average. Obviously, the more you invest, the better. But if you hit that number consistently, again, after 10 years, you'll have $1 million to your name. Imagine yourself, maybe you're 38, like yours truly, and you have 10 years ahead of you. If you save $5,000 consistently every month, by the time you're 48, you should have $1 million to your name. And by the time you're approaching or in your early 40s, if your finances are within that range, you're doing an all right job. Let me know if I'm doing a good job of entertaining you on all things personal finances by leaving a comment down below, liking the video, and subscribing to the channel. Let your friends know as well by sharing this video with them. Every little bit helps to continue to grow our community. And remember that a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take it easy, gang. I'll catch you next time.